Hey everyone, today on the final bar, I'm joined by Jeff Huge from JWH Investment Partners in Minneapolis. Talk about some of the charts that he is focused on this week. We've got a lot of things to talk about with the S&P, the Nasdaq especially rebounding pretty heavily off after their recent deterioration into the beginning of this week. Meta Platforms, FB, obviously leading the way higher, but PayPal and others, Qualcomm moving with some pretty good up moves. Is this a short-term bounce within the longer term trend? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the technical analysis toolkit to quantify investor behavior, to better understand market dynamics, respect the lessons of market history. And I feel like in the last couple of weeks, we've gotten great lessons from the market, great master classes in terms of why those things are all so important. We talk about market history often either directly or indirectly through the charts that we show on the final bar and on stock charts. I learned that technical analysis was all about getting inside other investors' heads and learning from the lessons of the past, learning what the market has done in different cycles, and being a well-informed investor is all about thinking about where we're at right now versus where we've been. What periods, what cycles, what eras does this current environment remind you of, and why? And it's a great way to it's a great starting point for that discussion. So, not surprising, having been through a number of bull cycles and bear cycles in my career, not surprised to see a huge move higher after a big acceleration to the downside. Down moves like you saw on Monday and today, are severe, are in many ways very, very sudden, but not usually sustainable, right? It tells you there's an acceleration, but at some point, things get cheap enough by some measure that buyers start to come in, buying power starts to improve, or sellers are exhausted. Everyone's sort of taken those bets off the table, and then there's demand that comes in and pushes things higher. So we're certainly seeing that today with NASDAQ, with technology up over 4%, the NASDAQ composite up over 3% today. We'll get to all those charts here in a short while, including a conversation with Jeff Huge. Guests next week, so we'll be back with guests on Tuesday. We have Jeff Weiss, who is one of my mentors. He's with Clearview Trading Advisors. He's an expert in long-term technical analysis. I'm excited to see what charts he wants to bring with him. On Wednesday, the 4th, we have Katie Stockton from Fairlead Strategies in Connecticut. And then on Thursday, the 5th, Chris Vermeulen from the Technical Traders, one of the best at educating novice traders and investors on how to apply our craft to the markets. So we'll see what charts are speaking to him. Also, as a reminder, we just aired our our stock charts draft. Really, the NFL draft starts tonight. The stock charts draft occurred last week into this week. We just airing that earlier this week, I think yesterday. And you can go to stockchartstv.com to see that fantastic discussion about stock picking and identifying a couple of equities to put in your team. Let's get on to our market recap. A lot of things happening. We're heavy into earnings. We have the Fed coming up next week, and a lot of competing narratives to go through. We'll cover as much as we can from a technical perspective today, and let's debrief a little bit on what the markets have actually done. The Dow up just under 2%, the S&P up 2.5%, the Nasdaq up 3%. This is really a FANG-led rally. Meta Platforms leading the way higher, but as you look at my dashboard, I have a watch list of the 6 FanMag stocks, sort of the FANG, along with Microsoft is that group of names, and then the New York FANG Plus Index. And it's a great way of just seeing some key leadership names in what they're doing. So when these mega cap tech and consumer and communications names are up this much, there's no way the market is doing anything but accelerating to the upside. And that's certainly what you're seeing today. It was a fairly broad advance today, though, with most sectors, with all of the sectors higher, and most equities in general tending to follow the leadership of those mega cap names. The VIX back below 30 today, just a tick or two below that. And let's keep going with some other asset classes. Interest rates moving a little bit higher today, with the 30-year yield just below 3%, 10-year yield just below 2.9%, getting very close to that 3% level. And it's almost laughable that we're talking about it, because not too long ago, 3% felt like the unattainable goal that we would never reach. We're there. And the questions now is what's next? And I'm excited to talk with my guest today, Jeff Huge, about that particular question a little later. Dollar continues to move higher as well. The dollar index using the UUP, which is a bullish dollar ETF, was up about 0.6% today. Commodities mixed, to be honest with you. The commodity ETF, we usually refer to, the DBC, was up about 0.8%. Gold up about 0.5% as well. But silver, copper prices a little bit lower. Natural gas prices lower today. Those are all using the ETFs that you see noted on my screen. Finally, cryptocurrencies mixed as well, but the major ones that we track, Bitcoin and Ether, have had a choppy couple days here, among many choppy days, but at the moment up about 1.5% on Bitcoin, 1.8% on Ether. Let's look at the daily chart of the S&P 500, and you can see what's been happening. So here's today's bar here, and this is really about a move off of those swing lows. You see the last week as a breakdown of that last Fibonacci support level around 43.80. That was the bounce we saw about 2 weeks ago. And then the break below there, which went into Monday and Tuesday of this week. Then we retest sort of this general area of the lows. And, there's been a lot of big down days and wide ranges on some of these bars. So the range of the lowest days ranges really from 41.10 up to 42.25. So it's quite a big area here, from this green shaded area at the top around 4,200 to the lows that we saw in February around 41.10. Right now, we're right within that range of those low bars in the last couple of days. So today, a very reasonable, if not fairly predictable, move off of lows. I mean, in any case, even if the market's going to accelerate to the downside and go to 3,200, which I don't see as particularly likely, but certainly possible, or if the market rips higher and goes to 5,000 in the next month, which I also think is possible but unlikely, either way, this sort of move off of support is sort of what's happened. And that's what I found has been really helpful about studying technical analysis in previous cycles, is you can see how the market often bounces off of well-established support levels. So I feel like a day like today validates pretty much everyone, right? If you're bearish, a day like today makes a ton of sense as a bounce off of support. It's all about what happens next. Do we see further improvement? Do we see further accumulation that tells you that this day was not just a fluke, but something a little bit more? Or do we see that re-exertion of the downside? People excited to buy at the lows have now bought. And now that continued selling pressure, which has certainly been expressing itself through lower prices over the last 3 to 4 weeks, continues. And that's when you'd see a break to new swing lows. So I think all eyes at this support range that we've bounced off of, sort of widely 41.10 up to 4,200. We've currently bounced off of that. Do we get back down into that level? So a key week among, again, I feel like I've said it's a key week many times, but certainly we've had a lot of support and resistance levels into play. I think all eyes on the low from this week to see if that's able to hold or not. Looking back at the dashboard, I just want to highlight the strength in some of those growth sectors like tech and communication services, both up 4% plus. Energy, though, was third, up 3%, followed by consumer discretionary, up 2.1%. So some of these sectors obviously dominated by some fairly large names, which had nice rallies. Meta up 17.5%, PayPal up over 10%, Qualcomm up almost that, Adesk up over 8%. So a lot of stocks within those sectors did very, very well today, which is certainly providing that boost to those particular sectors. But energy as well, if you look at some of the names that had the biggest improvement, you're seeing stocks like Valero making a new high today. So even energy, which had been pulling back just a bit, rotating to new highs. When I'm looking at the new highs list, I'm seeing a number of energy stocks, VLO in particular, up about 5.5%. What underperformed today? Utilities, industrials, financials at the bottom of the list. All of those positives. So the worst performing sector was utilities, still up over 1%. So broad advance today from a sector perspective. You can see that the strength in the growth sectors at the top, certainly enough to push the major indexes up off of those lows. And I would be laser focused on some of those swing lows on particular names to see if they're able to hold or not. Let's look at a chart of Meta Platforms here just to try to make sense of this chart. So Facebook or Meta Platforms certainly has become more of a gappy chart And what I mean is you have this proliferation of price gaps with huge changes in valuation overnight. Last big gap was that gap lower. Facebook and Netflix both had those gaps early in the first quarter, and certainly changed the profile of the charts very, very quickly. From there, it was very notable that after that gap lower, there wasn't just a quick reversion to the upside. Meta platforms continued lower, right? Pushing down below 200, bounced higher back up to the 50-day moving average at the end of March, beginning of April, sort of rode the 50-day moving average down, and then making a new swing low earlier this week, just below 170. Today, gapping higher. Now, a couple thoughts here. Number one, it's important to pay attention to that gap. Anytime you have a big a gap on the chart, that's a change in valuation from one day to the next. Tells you something has happened. Obviously, earnings pushing the price up very, very quickly. The question is, do we fill the gap? Does that gap hold? And so I would be focusing on the low of today to see if that comes back in play. A lot of times what you'll find is a gap higher. People that are very happy to have made a quick 40 points on Meta platforms are happy taking a bit of a profit. Price comes down a little bit. And the question is, do you get that renewed demand? And that's when you start to find if this is just a fluke or if you see additional buyers coming in, really buying into this long-term rotation on FB. The thing that's a challenge with this chart from a technical perspective is that the last level of resistance is a pretty far ways off, right? You have to go all the way up to around 235, 240 to eclipse the highs from the beginning of this month. So while the bounce certainly impressive, the earnings certainly encouraging a lot of investors to jump in here. From a technical perspective, this is still technically in a downtrend with lower highs and lower lows, but I'd be watching a potential bullish momentum divergence. That most recent new low met by a higher reading on the momentum. Let's take a quick break. We'll be back with today's guest, Jeff Hughes. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We really appreciate you joining us every weekday after the close as we break down these markets using the power of stock charts. A couple quick announcements before we get to today's guest, Jeff Hughes. First off, we welcome your questions. We'll do a mailbag segment tomorrow on Friday's show. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours in our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. Fantastic, knowledgeable guests like Jeff Hughes, many other great conversations we've had with Tony Dwyer, so many more in recent weeks to help us make sense of things. Special events like the pitch, our Stock Charts draft, all available for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Jeff Hughes. Jeff is the founder of JWH Investment Partners based in Minneapolis. Jeff's a regular on the show, always brings some really good long-term charts to help put things into perspective. Jeff, it's great to see you, great to hear you, and welcome back today.
Well, great to be here, Dave. Thanks for having me on the show.
Absolutely. We have a lot going on this week, as I know you're aware of, right? Heavy earnings. We've got a lot of competing narratives. The Fed coming up next week, and I think a lot of attention obviously focused there. You're starting us with a longer term perspective on the S&P. How are you making sense of this current move? How does it fit into your picture here?
Yeah, so we're looking at a weekly range chart that goes back about 3 years. And clearly the January 4th high appears now to have been something of a pivotal high, if not the high. We've come down and we've broken some pretty key levels of support. We like to use the 30-week moving average, and then we run an exponential 20-week moving average over the top of it. So the 30-week is in red, the 20 in green. And what we've seen is a violation or a breach of that sort of trend support at both levels. And in fact, the 20-week is actually broke below the 30-week, generating something of a signal, of a sell signal, if you will. The other thing that we've been following closely is that the October 4th lows have been violated. Back in February, we made a new low on February 24th that took out that kind of 4,300 level on the S&P. And we rallied in 3 waves, which to me is counter trend. That took us up to a little bit better than 4,600. We recovered the moving averages, but we couldn't hold those moving average. But what we did is we established kind of a new level of trend support off that Feb 24th low if we connect it with the trend line to the March 2020 low. And we've subsequently violated that level as well and breached the 4,300 level again. This puts into play what I would describe as a classic pattern top formation of the head and shoulders variety. Now, it's not confirmed exactly yet, and I believe a break below 4,100, if sustained, would confirm that top formation and would actually project a measured move to approximately 3,600 on the S&P 500.
Wow, it's certainly something that could play out. I'm assuming you're basing that sort of the traditional measure, right? Like sort of the height of that pattern, projecting it from the breakdown level, right?
Yeah, exactly.
Yeah, I'm reminded, Jeff, when you used to visit me in my Fidelity days, looking at the chart rooms, taking a step back and seeing a chart like this, it's hard to see it as anything but kind of distributed as you're showing that rotation down. Now, obviously, for a lot of investors and hopefully all of them, they're focused on interest rates because that's been a big rotation as you've seen rates going higher. What's your outlook for the 10-year here?
Well, the 10-year yield has actually achieved my near-term target of about 3%. I think it printed about 295 earlier in the week. But the thing that's important about this chart, and this is a 60-year history of the 10-year yield, and it's illustrating a 40-year downtrend that is now being challenged. And we've already taken out the 10-year moving average with authority, and we are now above the 40-year downtrend line. And it appears that we're poised to challenge what I would describe as chart resistance, which would be the December 2018 high in the 10-year, which was about 324. I think if we print above 324, that would resolve another pattern, a deep base pattern that would actually project much higher. But my suspicion is that we're going to run into what looks like the regression mean, a 60-year regression mean, which actually converges with that chart resistance line. And so that might reject, the price action initially, give it a chance to kind of, retrench a bit and kind of regroup. And my sense is the next challenge would then break out. So this could be a multi-year process, but a breach above, or I should say a breakout above that 3.25 level would count to over 6% on the 10-year bond yield. And in my opinion, the Fed is so far behind the curve in terms of inflation that it's not an unrealistic projection if we're thinking out a year or two, basically.
Yeah, we had talked before we went live here. When you last appeared at the end of January, you mentioned that the chart of the 10-year was the most important chart in the world. And I can't disagree. It's been a great illustration, certainly of the leadership in the markets. Now, you mentioned inflation. Your last the table here is looking at some of the measures of inflation. Can you talk us through this one?
Yeah, we took this chart from the Atlanta Fed's inflation dashboard, and that red line in the middle, big bold print, that's indicating 9 different measures that the Federal Reserve Board calculates among the various banks around the country that look at core inflation, not headline inflation, but the really sticky inflation, the kind with teeth, like wage inflation, certain commodities, rents, things like that really dig in and don't really budge based on economic activity. In other words, once you've raised my salary, you're not going to take it back. Once you've raised my rent and I've signed a 2-year lease, that's it. If they haven't produced oil for the last 2 years, it's going to take a while to build up that production and ramp it up. And so, this tends to be sticky type inflation. And if you take a look at where we were a year ago, core inflation was under 2%. Today, it's over 5%. There's a 300 basis point change that's taken place in the last year, and the Fed hasn't caught up to that. I think those on the street that are watching Fed funds action are projecting a 50 basis point hike on May 4th. And if in fact we get that, I think it's probably going to be the first of many where the Fed actually takes aggressive action to catch up with this inflation rate and hold it at bay.
could be an exciting week to come after I feel like many exciting weeks in the market here. Jeff, we have to leave it there. I really appreciate you sharing us some really good perspectives, some long-term targets to pay attention to. Stay safe there in the upper Midwest. We'll talk to you again soon.
Thanks, Dave. Always a pleasure.
That's Jeff Hughes from JWH Investment Partners coming to us from Minneapolis. His second chart with the 10-year interest rate was just a fascinating one. I love that long-term move, and I mentioned the chart room at Fidelity, where I spent a good amount of time, and one of my favorite charts there was a long-term view of interest rates, and that chart that Jeff shared really shows that story. Talk about the incredible long-term bull market in bonds with rates coming down so consistently, really starting to rotate. And at some point, I feel like more and more investors are recognizing the reality of a higher rate environment. Just think about what that means for the FANG stocks. Think about what that means for leadership from cyclicals versus growth-oriented parts of the market. So a number of things that I was jotting down, a number of things to follow up on. Great take there from Jeff Hughes. Let's continue on today's show with our next segment, Getting Sentimental. We love to do on a Thursday is focus on some of the sentiment data. A lot of the survey data is updated every week. And so if we can check in on Thursday, it actually is a pretty good time to focus on things. We'll talk about three main areas here, as we usually do. We'll talk about volatility to start with. We'll go to survey data, the AAII, and the name exposure index. And then finally, we'll talk about put call ratios. And my introduction to all of this is it's all about extremes right now. We start with the VIX, which is just touching 30 from above, spiked above 30 on the sell-off. And as I describe usually when I bring up this chart of the VIX is not absolutely bound. Things like RSI have a defined range from 0 to 100. Can't go below 0, can't go above 100 because of the math involved in creating the oscillator. So you have a clear sense of what's high and what's low because you know the absolute range. The VIX can fluctuate quite a bit. And I think a lot of investors have gotten into trouble when they see the VIX go above a certain level and just assume that's it. But recognizing that the volatility regime is what's important, I think is super valuable. So 2019, relatively low volatility, 2020, extreme volatility. We settled in the second half of 2020, first quarter in 2021 into a sort of an easy volatility range between around 20 and 40. In the middle of 2021, the summer doldrums, the entire volatility range was compressed to the downside. We never really got below 15, never really got above 25. Now we've settled into a new range between around 20 and just above 30 on the upper range. So if you start the clock about 6 months ago, if you bought every time the VIX touched 30 or at worst started to look opportunistically when we got above 30, you identified basically the four major turns that we've seen so far in the year, assuming this current one we're in is part of a bit of a bounce. If you look at when the VIX got down to 20, these are the short-term peaks that you saw in the S&P 500, because the VIX getting up to 20, the market had rallied, the volatility had settled down, and it was usually time for a peak. So that is going to work until it doesn't, and that's why I can't tell you, here's your new trading system. It's easy. Buy when the VIX hits 30, sell when it hits 20, because that's going to work until it doesn't, right? That range is going to work until we get to a new volatility regime. But for now, I think it could be very meaningful that the VIX has gotten above 30 and now just starting to get below. We get back below 30 here going into weekend. I think that tells you we're at the very least getting a bit more of a bounce here off of those lows. The question is the long-term trajectory, and I thought Jeff did a great job, Jeff Hughes, at illustrating some of those concepts. Now let's get into some survey data. We have the AAII survey. This is an important chart because we are truly at an extreme here. These numbers just came out today. The bullish reading is down just above 16%, which is one of the lowest bullish readings that you will see in the history of the indicator. The bears are almost to 60%, which is, again, one of the highest readings in bearishness that we've seen. The spread between the two is around 43%, which is basically bulls minus bear, the spread between these two. That is the most negative that it has been, again, in long-term history. What I want to do to just put that into context, we're looking at the last 5 years here. Let's go back around 25 years. This will take us back before the 2000 high and take us back into the late 90s. Now, this is hard to read individual observations, but just look at the long-term trends with me. Here we have a horizontal line indicating 16% bulls, which is where we've been at. The only other times going back for 25 years that we've been this low is in early 2016, in mid 2016, sort of those short-term bottoms. Going back, that is literally it. Those are the only times we've had this low of a bullish reading. And again, I'm not going beyond the late 90s because I feel like the market was so different then. Bearishness almost to 60%, incredibly rare. The only other times we saw that reading were a cluster of readings in 2000 to early 2009, which is an important observation. Mid 2006, which is a buyable dip within this uptrend off the 2003 lows. The 2003 low was also this extreme bearishness. The 2002 lows actually did not get this negative. It took that final retest of the lows in March 2003 to get the levels this low. The spread between the two, the only other time going back 25 years that the spread has been this severe was in early 2009. So before you go saying, obviously this is a bottom, because look at that. Here's what concerns me. Look at how rare it is for the bears to be this strong. Look at how rare it is for the spread between bulls and bears to be this negative. It's only ever happened before in the last 25 years after an extended cyclical bear market. In 2003, we'd already been going down a couple of years. In 2009, we'd been going through the financial crisis and prices had depreciated quite a bit. We're nowhere near that level of bombed out market, and we're already seeing this level of bearishness emerge. So I would argue that it's before you can say that obviously this is a bottom because the sentiment's so negative. This is sad to say it. I'm saying the four worst, most painful words as an investor. This time is different. Maybe I'll do 5 words. This time might be different because you're seeing us showing similarities to late stage cyclical bear markets, not the beginning of a cyclical bear market. This could very much be, pun intended, uncharted territory. Just want to finish out. We don't really have much time to hit the name exposure index, but I just want to mention it's gapped down quite a bit back below 50%, which shows money managers are getting fairly defensive. The put call ratios have spiked well above the averages that we've seen going back to the March 2020 low. So sentiment has very much become bombed out. You're seeing extremes in volatility, extremes in survey data, extremes in put call ratios, which usually have lined up with market bottoms. And I'd be watching these charts very closely to see if those sort of movements play out. Let's wrap the show, folks. Go to the 3 in 3, 3 charts that tell the story of this market in 3 minutes. Chart number 1, we didn't talk much about breadth. And again, we didn't have a live show earlier this week because the StockCharts TV team was on the road. However, if I had a show yesterday, I would have talked about this particular chart. Stocks above their 200-day moving average in the S&P 500 below 50%. We're right around 43%. That most likely bounces today given the rally that we saw. But overall, this remains below 50%. This is a bear market feel for sure. 50% stocks below their stocks above their 50-day moving average, getting down to that 30% level, which is where we've bottomed out in September, in December, in January, in February, in March. We're not quite there yet. And so that tells me maybe to expect a little further downside before, at least before all is said and done. Chart number 2, we'll look at the AAII survey. I spent a good amount of time, more than I anticipated, talking about the long-term history, but I think it's just a great history lesson when you see an extreme in an indicator and you can go back to the deep history. I think that's what the StockCharts platform is designed so well for. And if you look here, you can see we are in a very rare, very limited number of occurrences where the sentiment has been this negative. Usually that's meant a market bottom, but usually it's happened after the price has deteriorated already. So we may be in that situation where we're just early on and the negative sentiment may persist for longer than you might expect. Finally, charts like Meta platforms are super tempting because they've bounced and gapped higher off of the lows. I would say when you have a big move after earnings, the next day is super important. I would look to see what Friday's session does. You see further buying. Is it just not a one-day freak thing, but is it more of a building of accumulation, not just people trying to buy a cheap stock, a good company at a discount, but investors really trying to ride the movements a little bit higher. So watch that chart to see if you see further upside. 235, the short-term resistance there. Folks, that is our show for today. I want to thank you all for joining us every weekday after the close. All of our previous episodes and great interviews at StockChartsTV.com. Thank you to Jeff Huge from JWH Investment Partners joining us from Minnesota. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.